So should you pay off your home loan early or invest the extra cash? This is a question many Australians ask themselves every day, and the answer is not that straightforward. So in this video, I'll discuss the pros and cons of both options and show you the historical performance over the past 30 years to help you make an informed decision. Let's get straight into it. Let's start off with how a home loan works in Australia. A home loan or mortgage is money you borrow from a bank or lender to buy property. In Australia, most home loans run for 30 years, although you can usually pay them off earlier. Most Aussies with a home loan are required to make principal plus interest repayments. Each payment reduces both the loan balance, which is the principal, and covers the interest. For example, let's say you borrow $600K from the bank at a 6% interest rate. The bank uses an amortization formula to spread the loan over 30 years. They will then ask you to make monthly repayments consisting of two parts. 1. The principal, which is the amount you actually borrowed from the bank. And 2. The interest, which is the cost of borrowing that money. In this case, the monthly repayment works out to be around $3,597 per month. What's interesting is that in the first month's repayment, $3,000 goes straight to the interest portion and only $597 goes to the principal. This payment structure is known as an amortization schedule, where banks front load interest to protect their return. So if you sell or refinance after only a few years, they've already collected a significant portion of the interest. This is how banks make their money. Your repayment is designed to be the same each month for the next 30 years. Because of the way it's structured, at the start, because the balance is large, interest will dominate. As the balance slowly shrinks, the interest charge reduces, so more of your fixed repayment is freed up to pay down principal. Let's now examine the historical performance of both options over the past 30 years. So from 1995 to 2025 to see how the numbers truly compare. First, let's look at home loans. Many variables affect home loan rates, including your loan type, which bank you're with, and changes in reporting standards in Australia over the last decades. However, over the last 30 years, the long-run average home loan rate is estimated at approximately 6.8% per year. Let's now compare that to the stock market. According to this recent chart by Vanguard, Australian shares have returned around 9.3% per year on average over the last 30 years. Throughout this period, investing in Australian shares has outperformed the average home loan rate by about 2 to 3% annually. So how about the US stock market during the same time frame? Well, looking at Vanguard's chart again, US shares have returned approximately 10.8% on average during this period, which is a bit higher than the ASX, with particularly strong growth during the tech boom of the late 90s and the massive rally after 2009. This means that over the last 30 years, investing in US shares has outperformed the cost of home loans by around 3 to 4%. Let's go through a worked example to compare the two options. Let's say you borrowed $600K from the bank at a 6% interest rate to buy your first home. If you made $500 extra monthly repayments on top of your original repayment schedule for the next 30 years, you would save around $212K in total interest and reduce your home loan term by approximately 8 years. If instead you invested that $500 into the stock market every month for the next 30 years, at an assumed annual return of 10%, which is the historical stock market average, you would earn over $800K. That is a big difference. Even with a more modest 8% return, you would still earn around $500K. And even if you matched the home loan interest rate of 6%, you would still earn almost $300K from investing in shares, which is more than the $212K saved by making extra mortgage repayments. So you might be wondering why investing earns a higher return even when you use the same 6% in both scenarios. The difference is the power of compounding. Let me explain. Mortgage savings is linear. It's flat, steady, and the same every year. Imagine you put $10K into your mortgage. Your loan rate is 6%. That saves you $600 in interest every year. But the savings stays about the same each year. $600, $600, $600 until the loan is gone. After 30 years, you'll save around $18K in interest. It's like stopping a leak in a bucket. It's useful, but the bucket never fills up with more water. On the other hand, investing returns involves compounding. Let's say you invest that same $10K at a 6% return. Now instead of saving interest, your money is growing. Year 1, you earn $600, same as the loan. Year 2, you now earn 6% on $10,600, which is $636. Year 3, you earn 6% on $11,236, which is $674. And it keeps snowballing from there. After 30 years, your 10K has turned into about 57K, with 47K of pure gains. And again, that's only at 6%. If you receive the historical stock market average of 8 to 10%, then the figure will be even higher. It's like planting a tree. At first it grows slowly, but after a while it grows faster and faster. So right now you're probably wondering, if investing usually outperforms paying off your home loan early, shouldn't everyone just invest instead? Well no, it's not that simple. There are several other important factors to consider, which I'll explain now. The pros of paying off your home loan. So why do people still pay down their home loan early? Here are 3 compelling reasons. 1. Guaranteed returns. Think about it. When you invest in the stock market, your money can fluctuate up and down. There's inherent risk involved. But when you pay down your home loan, you're essentially locking in a risk-free and tax-free return equal to your interest rate. For example, if you have a $300K loan at 4% interest over 30 years, and you decide to pay it off in 15 years instead, you could save around $107K in interest. That's equivalent to earning a guaranteed 4% return annually with zero risk. Similar to parking money in an offset account, these interest savings are also tax-free because according to the ATO, you cannot be taxed on money you save. In contrast, when you invest in stocks or property, you must pay tax on any capital gains and income you receive. That's the advantage of guaranteed returns. They might be less exciting, but they provide certainty and security. And some people prefer it that way. The second advantage is less interest and more equity. Every extra repayment you make chips away at your interest bill. And over decades, that adds up to tens if not hundreds of thousands of dollars saved. But it's not just about saving money. Paying off more means you're building equity faster. Equity is simply the portion of your home that you actually own. Here is the formula to calculate your equity. The more equity you have, the stronger your financial position becomes. Think of it like filling a bucket. Every dollar you pay towards the loan becomes yours, not the bank's. And if you ever need to refinance, use equity for renovations, or even a security for another investment property, that extra ownership can make all the difference. And finally, the last advantage is peace of mind. This one is harder to measure with numbers, but it's often the most important. When you're mortgage free, you don't have to stress about interest rate hikes, losing your job, or surprise expenses. Remember what happened in 2022 and 2023? Interest rates jumped from record lows back to over 6% almost overnight. While households already financially stretched, monthly repayments suddenly increased by hundreds, sometimes thousands of dollars. But if you pay down your home loan, you don't have to worry about any of that. You own your home outright, and that security is priceless. It's not just financial freedom, it's mental freedom too. And to some people who just want to live a simple life, this is everything. The advantages of investing instead. Alright, so on the flip side, what about investing that extra cash? Well, there are 3 big reasons why investors normally choose this path, and they can be quite powerful. Let's go through them. Number 1, higher potential returns. Here's the reality. Over the long term, the stock market has outperformed mortgage rates in Australia. That is a fact. Putting extra money into your home loan gives you a guaranteed return equal to your interest rate. But as we saw from the previous example, that benefit is capped and grows in a straight line. Each extra dollar saves you the same amount of interest every year. By contrast, investing offers higher potential returns because the stock market has historically delivered 8 to 10% annually over the long term, and those gains compound over time, meaning your returns generate more returns. Over 30 years, 10k put into a mortgage might save 18 to 20k in interest. But if you invested that 10k at 8%, it could grow to 100k. And at 10%, it could grow to 174k. That's why investing generally has greater upside, although it does come with a bit more risk. The second advantage of investing is tax advantages. This is where investing really gets clever. In Australia, certain investments come with powerful tax benefits. Shares often pay dividends with franking credits, meaning the company has already paid taxes on that income, so you could get a tax offset. Capital gains discounts reward long-term investors by reducing tax on profits by 50% when you hold investments for more than 12 months. This includes shares, real estate, and other assets. If you go down the property investing route, you can take advantage of negative gearing. Negative gearing occurs when your property expenses, such as home loan interest, is higher than your rental income, which allows you to offset that loss against your taxable income, hence reducing the amount of tax you have to pay overall. The bottom line is, smart investing doesn't just make money, it can also reduce your tax bill. And that's something paying off your home loan simply cannot do. And the third advantage of investing is liquidity and diversification. When you throw extra money into your home loan, it's locked into your house. You can't easily get it back out unless you refinance or sell. But with investments like shares or ETFs, you can sell anytime and access your money within a couple of days. This kind of flexibility is priceless when life throws you a curveball. I mean, you can't just sell 5% of your house to cover a personal emergency. Shares, on the other hand, lets you do this. Plus, investing lets you diversify, spreading out your money across different industries, countries, and even asset classes. This way, you're not just tied to one property in one suburb in one country. In other words, investing gives you access, choice, and control. 3 things you don't get by locking all your spare cash into your home loan. Risk and trade-offs. Now, it's not all sunshines and rainbows. Whether you're paying off your home loan faster or investing instead, there are some real trade-offs you need to think about. Let's go through them one by one. The first one is market volatility. Yes, investing can deliver higher returns than your home loan rate, but these returns are not guaranteed. Markets move in cycles. Just think back to 2008 during the global financial crisis. The ASX dropped almost 40%. And more recently, in 2022, markets had another big dip before bouncing back. Now, if you invested instead of paying down your loan, your portfolio might have taken a serious hit during those times. You need to have emotional resilience to withstand these market downturns without panic selling. It sounds easy until it's happening to you in real life and you see your portfolio in red. On the other hand, paying off your home loan gives you a steady, risk-free return equal to your interest rates. No crashes, no volatility, just certainty. Number 2, loss of liquidity. Every extra repayment you make locks money into your property. Unlike shares, you can't simply sell a portion of your home when you need cash quickly. While refinancing or using a redraw facility is possible, These options require time, paperwork, and bank approval. If unexpected situations arise, like you lose your job, have unexpected medical expenses, or investment opportunities, you might struggle to access these extra funds you committed to your mortgage. 3. Costs and penalties. Some loans have restrictions on extra repayments or charge early repayment fees if you pay off too much too soon, especially with fixed rate loans. That means you might think you're saving thousands, but you're copping fees that eat into your advantage. So always check the fine print of your home loan before you decide to go all in on extra repayments. An alternative solution is linking your home loan to an offset account. An offset account is essentially a transaction account connected to your home loan where any money you park in there is offsetting your loan balance when calculating interest. For example, if you have a 500k loan and 50k in your offset account, you'll only pay interest on 450k. The good thing about offset accounts is unlike extra repayments, you can access this money anytime you need it. However, this flexibility comes at a cost, literally. Since most offset accounts are included in home loan packages with an annual fee, which is typically around $250 to $400 per year. And finally, the big one, a false sense of comfort. Recently, one financial advisor sparked controversy by claiming that paying off your home loan is actually the worst investment you'll ever make. Sounds harsh, right? But here's the argument. If you focus solely on your principal home, you might feel secure, but you're limiting your ability to grow wealth elsewhere. Your money becomes tied to a single asset in one suburb, in one country. Another high-profile investor even suggested that renting and investing the difference can sometimes make more sense because it frees up your equity and gives you flexibility. Now, I'm not saying they're right or wrong, but the point is paying off your home too aggressively might prevent you from building a more diversified wealth strategy. Just something to think about. Some important variables. So now we've looked at both sides, the benefits of paying down your home loan and the advantages of investing. But ultimately, the right choice depends on your personal situation. Here are 4 key questions you should ask yourself before deciding which path to take. 1. What is your risk tolerance? If the thought of your portfolio dropping 20% during a market crash keeps you up at night, then paying down your home loan might be your peace of mind path. It's safe, steadied, and guaranteed. There's no shame in it at all. But if you're comfortable riding the ups and downs of the share market, knowing that historically long-term investors have come out on top, then investing might suit you better. 2. What is your time horizon? Investing typically rewards patience. If you have 10, 20, or even 30 years before needing the money, shares and ETFs can compound dramatically over time. But if you're nearing retirement or simply want the security of being debt-free sooner, directing extra money into your home loan might be the wiser choice. 3. What's your home loan rate? If your loan rate is low, like 2% back in 2020, paying it down only gives you a tiny guaranteed return. In that case, investing in shares, which we all know by now historically returns 8 to 10% per annum, might be the better move number-wise. But if your loan rate is high, say 67% like we've seen in recent years, paying it down becomes more appealing when compared to stock market averages, since there's only a few percentage points difference. Maybe if you are a bit risk averse, you may prefer the security of a guaranteed return from paying off your mortgage. 4. Do you have an emergency fund? Before you throw every spare dollar into the home loan or the stock market, please make sure you built up an emergency fund. An emergency fund is money you set aside in a safe, easily accessible account to cover unexpected expenses. It should cover 3 to 6 months worth of living expenses if something bad happens to you. Think of it as your financial safety net, because life happens. You may lose your job, get an unexpected medical bill, or your car breaks down. If all your money is locked away in your home or tied up in investments that are down when you need to sell, you could be in a tough spot. You don't want to go into credit card debt to dig yourself out of the hole in that situation. So always build that emergency buffer first, usually 3 to 6 months of expenses in cash before worrying about mortgage versus investing. A balanced approach. Okay, so we looked into the pros and cons of paying off your mortgage or investing. But here's the truth. You don't actually have to pick just one. A balanced approach can give you the best of both worlds. Here's how it works. Instead of putting all your spare cash into your home loan or all of it into investments, you split it. For example, say you have an extra $500 each month. You might throw $250 towards your home loan, reducing your loan, cutting down the interest, and building equity. And then you can put the other $250 into your investment portfolio where it can compound and grow. This strategy is smart for 2 reasons. 1, you're still making progress on your loan, shaving years of your home loan, and saving thousands in interest. And 2, you're building an investment habit at the same time by letting your money work for you in the markets. That way, you're not stuck with all your wealth tied up in one house. And you're not putting everything into volatile markets either. You can enjoy the best of both worlds. The beauty of this approach is flexibility. If rates suddenly jump and mortgage repayments start to go crazy, you can shift more into the loan. If the market's offering great opportunities, you can lean a bit more into investing. And all the while, you got peace of mind that you're growing wealth and reducing debt no matter what the economy is doing. So, after knowing all this, which option is better? Well, historically speaking, investing in the stock market has generally outperformed paying off home loans over the past 30 years in Australia. So the numbers point towards investing as the better financial option. As a general rule of thumb, Investing tends to be more advantageous when interest rates are lower and when you have a longer time horizon. However, paying off your home loan is safer and provides you with more emotional security, something which cannot be understated for some people. So it's completely up to you. There is not really a wrong answer here. And again, you can always do both to hedge your bets. By the way, I've included links to all the calculators used in this video in the description below. Please feel free to use them to run the numbers for your own situation. And quick disclaimer, this video is for educational purposes only and should not be considered financial advice. Remember that investing involves risk and past performances does not guarantee future results. Please always do your own research, and if you'd like financial advice, please go speak to a professional. By the way, if you're enjoying this video and made it this far, comment the words cream cheese bagel down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit the subscribe button and join this awesome community of like-minded people. Also, please consider signing up for my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, or any cool live updates from me. And if you want to learn how to start investing in shares this year, check out this video on screen where I'll show you a beginner's guide on how to start investing in Australia as a beginner. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.